Supplier credit terms, how to track and optimize your cash flow. Last month, one of my clients paid a $1,200 bill 5 days early and left $300 on the table. Why? Because they didn't understand their supplier credit terms. Meanwhile, another client is drowning in cash flow problems while sitting on $60,000 in unused credit from suppliers. If you're not tracking and optimizing your supplier credit terms, you're either leaving money on the table or strangling your cash flow. Today, I'm going to show you exactly how to use supplier credit strategically so you keep more cash in your business where it belongs. Hey everyone, I'm Bev. And as a bookkeeping coach, I've seen businesses fail not because they weren't profitable, but because they mismanaged their cash flow. And one of the biggest levers for cash flow that business owners completely ignore is supplier credit terms. Here's what most people don't realize. The terms you negotiate with suppliers and how you manage those payments can be the difference between a healthy cash cushion and constantly scrambling to make payroll. Think about it. If you have 10 suppliers and you're paying each of them 10 days earlier than you need to, that's cash sitting in their bank account instead of yours. Cash you could use for inventory, marketing, hiring, or just having a buffer for emergencies. In the next 10 minutes, I'm going to decode supplier credit terms, show you how to track them properly, teach you negotiation strategies that actually work, and give you a system to optimize your cash flow without damaging supplier relationships. If you want to get smarter about managing your business finances, subscribe and hit that notification bell because I drop practical bookkeeping wisdom every single week. Let's start with the basics because I've had clients stare at invoices with no idea what those terms actually mean. Net 30, net 60, net 90, this is the simplest version. Net 30 means the full invoice amount is due within 30 days of the invoice date. No discounts, no penalties. Just pay within 30 days. Net 60 is 60 days, net 90 is 90 days. Pretty straightforward. But here's what matters. That number is free financing from your supplier. If you get a $10,000 invoice on net 30 terms, you can hold that $10,000 for a full month before you have to pay. That's working capital for you to use. 2/10 net 30, the early payment discount. This is where it gets interesting and where most business owners leave money on the table. 2-10 net 30 means if you pay within 10 days, you get a 2% discount. Otherwise, the full amount is due in 30 days. Let me show you why this matters. If you have $5,000 invoice with 2-10 net 30 terms, if you pay in 10 days, you only pay $4,900. You just saved $100. That's the 2% return in 20 days, which annualizes to 36% return on your money. That's better than most any investment you'll find. But, and this is crucial, you need to have the cash available to take advantage of it. Don't pay early just for the discount if it means you can't make payroll next week. 1% 10 net 30, 3/15 net 45, these work the same way, just different percentages and time frames. 1% 10 net 30 is a 1% discount if paid in 10 days. 3/15 is a discount in 45 days. Due on receipt, this means exactly what it says. Payment is expected immediately. You have no credit terms. This is common with new suppliers who don't know you yet or with COD, cash on delivery arrangements. EOM, end of month. Net 30 EOM means payment is due 30 days after the end of the month in which you received the invoice. So if you get the invoice dated March 3rd with net 30 EOM terms, it's not due until April 30th. This gives you extra time and is better for cash flow than a regular net 30. Here's my bookkeeping tip. If you don't understand the terms on an invoice, call the vendor and ask. Don't guess. I've seen businesses pay late fees because they misunderstood the terms. And I've seen businesses pay early and miss discounts because they didn't realize they had more time. Now, let's talk about why this matters so much for your cash flow. Imagine you have 5 major suppliers. Supplier A gives you net 15, supplier B gives you net 30, supplier C gives you net 60, supplier D requires payment on receipt, and supplier E gives you 2-10 net 30. If you're not tracking these terms and just paying bills as they come in, you're making terrible cash flow decisions. Maybe you're playing supplier C on day 20 when you have 60 days to pay, while you're stretching supplier A to day 30 and getting hit with late fees. The cash conversion cycle is a concept every business owner needs to understand. It's the time between when you pay for inventory or materials and when you collect payment from your customers. Let's say you're a retailer. You buy inventory and your supplier gives you net 30 terms. That inventory sits on your shelf for 45 days before it sells. Then your customer pays you in 15 days. Your cash conversion cycle is 30 days because you paid 30 days before you got the cash back. But what if you negotiated net 60 terms? Now, your cash conversion cycle is 0 days. You're collecting from your customer at the same time as you're paying your supplier. That's powerful. Or even better, what if you negotiated 90 days? Now you have negative cash conversion cycle of minus 30 days. Your customer is paying you a full month before you have to pay the supplier. That's how big retailers operate, and it's why they can grow so fast. The working capital benefit, every day you extend your payment terms, is another day that cash stays in your business. If you have $100,000 in monthly supplier expenses and you move from net 30 to net 45 terms, you just freed up $50,000 in working capital. That's $50,000 you can use for growth without taking on debt or giving up equity. This is why big companies are so aggressive about extending payment terms. They understand this creates free working capital. Okay, so you understand why terms matter. Now let's talk about how to actually track them, because this is where most businesses fail. Set up your accounting system correctly. In QuickBooks or whatever accounting software you use, every vendor should have their credit terms entered in their vendor profile. Don't skip this step. When you do it right, your system will automatically calculate due dates and tell you when payments are due. Go to your vendor list right now and check. Do you have terms entered for every single vendor? If not, call them. Find out what terms you have and enter them. Use the accounts payable aging report. This report is your best friend for managing supplier credit. It shows you every bill you owe, organized by how old they are, current 1 to 30 days, 31 to 60 days, 61 to 90 days, and over 90 days. Run this report weekly, not monthly. You should know exactly what you owe, when it's due, and what you can safely delay if cash is tight. But here's the key. You want everything in the current column or the 1 to 30 days column. If you have significant amounts in the 31 plus columns, you're paying late and damaging relationships. Create a payment calendar. I have my clients create a simple spreadsheet or use their accounting software to map out when payments are due. List every recurring supplier, a typical invoice amount, the terms, and the actual due date. This lets you see cash requirements for the next 30, 60, 90 days. You can plan ahead instead of being surprised when a big payment hits. Flag early payment discounts. Create a separate category or flag in your system for invoices with early payment discounts. These should get priority review. Every week, look at which invoices have discounts available and decide if you have the cash to take advantage of them. Remember the math I showed earlier. A 2% discount for paying 20 days early is a 36% annual return. If you have the cash, take it. If you don't, at least you made a conscious decision. Track your payment patterns. Run a report showing your average days to pay. If your suppliers give you net 30, but you're averaging 45 days to pay, you have a problem. Either you don't have enough cash flow or you're not managing your payables well. Both need to be fixed. Now, let's talk about how to actually negotiate better credit terms with your suppliers, because this is free money and most people never ask. The best time to negotiate is before you become a customer, when they want your business. But you can also renegotiate as an existing customer if you have leverage. You're a large account, you pay reliably, you've been with them for years. or you're increasing your order volume. The worst time to negotiate is when you're already late on payments. Fix your payments issue first, then negotiate. I know what you're thinking. Bev, what do I say? Don't be timid about this. Try something like, I'm planning to increase my order volume with you over the next year. I currently have net 30 terms, but my other major suppliers give me net 60. Can we move to net 60 terms to match? Or, I've been a reliable customer for 3 years and I always pay on time. I'd like to request extended terms of net 45 instead of net 30. This would help me commit to larger orders. Or, I'm evaluating my suppliers and payment terms are part of my decision criteria. What's the best terms you can offer for my volume level? Suppliers care about a few things: payment reliability, order volume, and relationship length. If you've been paying on time for a year, that's leverage. If you're about to place a large order, that's leverage. If you can commit to being exclusive with them or increasing your volume, that's huge leverage. Also, don't be afraid to mention competitor terms. I'm currently looking at supplier X who offers net 60. I'd prefer to work with you, but I need comparable terms. Alternative negotiation tactics? If they won't extend terms, negotiate for early payment discounts. Offer to pay in 10 days for a 2% discount. That gives you flexibility. Take the discount when you have cash, or pay it 30 days when you don't. Or negotiate for a credit limit increase. More credit means more flexibility in managing your cash flow. Some suppliers will give better terms if you set up automatic ACH payments instead of cutting checks. It saves them processing costs, and they know they'll get paid. Industry standards matter. Know what's normal in your industry. In retail, net 60 to net 90 is common. In construction, net 30 is standard. In wholesale distribution, you might see net 45. Don't accept worse terms than your competitors are getting. And here's an insider tip. Larger suppliers often have different terms for different customer segments. Make sure you're classified correctly. If you're being treated as a small account, but you're now buying at mid-size volumes, ask to be reclassified. Now let's put this all together into a cash flow optimization strategy. Strategy 1 is stack your payables. Try to negotiate longer terms with your largest suppliers. If you can move your 3 biggest expenses from net 30 to net 60, you've just freed up massive working capital. Focus your negotiation efforts where they'll have the biggest impact. Strategy 2, match payment terms to revenue cycles. If you get paid by customers in 45 days, make sure your supplier terms are at least 45 days. You don't want to pay suppliers before you collect from your customers. That creates a cash gap you have to fill. Service businesses, if you bill monthly and collect in net 30, negotiate net 45 or net 60 with your suppliers. Retail businesses, if inventory turns every 60 days, you need at least net 60 from your suppliers. Strategy 3, prioritize strategically. When cash is tight, you can't pay everyone on time. Here's the priority order. First, payroll and payroll taxes. Never miss these. Second, bills with early payment discounts that are worth taking. Third, suppliers with shorter terms, net 15 or net 30. And fourth, critical suppliers you can't afford to lose. Fifth, everyone else. Longest terms get paid last. But, and this is important, communicate with suppliers if you're going to be late. Don't just ghost them. Call, explain the situation, and tell them when you'll pay. Most will work with you if you're honest. Strategy 4, use credit lines wisely. If you have a business line or credit card, you can use it strategically. Pay suppliers early to get the discount, then pay off the credit line when your customer pays you. Just make sure the discount percentage is higher than your interest rate. Strategy 5, automate what you can. Set up automatic payments for bills due within the discount period. This ensures you never miss a discount opportunity due to oversight. For bills without discounts, schedule payments for the actual due date, not earlier. Let your accounting system handle the timing so you're not paying early by mistake. Strategy 6, seasonal adjustments. If you have seasonal cash flow, negotiate with suppliers for extended terms during your slow season. Many suppliers will work with you on this if you're upfront about your seasonal pattern. Before we wrap up, let me tell you the biggest mistakes I see business owners make with supplier credit. Mistake number one is paying everything immediately because you want to keep a zero balance. This is destroying your cash flow. Use credit terms you've been given. Mistake number two, paying late without communication. This damages relationships and gets you labeled as a risky customer. If you're going to be late, call first. Mistake three, missing early payment discounts because you're not tracking them. This is free money you're leaving on the table. Mistake four, not negotiating because you assume the two terms you're given are fixed. Everything is negotiable. Mistake five, paying on invoice date instead of waiting for the due date. The invoice date and due date are different. Mistake six, not reviewing your terms annually. As your business grows and your payment history improves, you should be getting better terms. Renegotiate every year. And finally, mixing personal feelings with business decisions. Don't pay your friend's business early just because they're your friend if it hurts your cash flow. Keep business and personal separate. Managing supplier credit terms isn't just about paying bills. It's about strategically using every tool available to optimize your cash flow. When you track terms properly, negotiate better terms, and pay strategically, you'll have more cash in your business to grow, invest, and weather rough patches. If this was helpful, hit that like button and subscribe for more cash flow and bookkeeping strategies. Comment below, what credit terms are you currently working with? And if you want help creating a cash flow management system for your business, check out my bookkeeping coaching program in the description. Thanks for watching. And remember, cash is king and credit terms are your secret weapon. See you in the next video.